Hi Vic, so we're here to talk about market developments so far this year. 2022 has got off to a pretty turbulent start. What have been the main developments that have affected the strategy so far this year?
So what we've seen in 2022 so far has really been a capitulation of trends that actually were emerging in 2021. So we started to see a rotation away from what are known as growth stocks and into areas that tend to do better in rising interest rate environments, so things like energy and financials. And this has been driven by rising levels of inflation, a recovery in growth post-COVID, and more consistent messaging from central banks about the possibility of interest rates going up in 2022. I think what's been different about this period has been the sharpness of those moves and the volatility within the period. We've seen some really big swings between days and also even within days. More recently, we've also had the terrible events in Ukraine, and first and foremost, that is a human crisis, but it obviously does create uncertainty in markets as well.
Absolutely. It's been the most extraordinary year. How has this affected the strategy's performance?
The biggest factor affecting performance has been the lack of exposure to energy and financials. We are structurally underweight given the nature of our portfolio, with no exposure to fossil fuels in particular. On the other side of that, we have more exposure to growth and quality areas that have underperformed in the period, so that's compounded things. I think what's important though is that that's the kind of performance I think we would expect in this environment, given the way that the portfolio is positioned in the long term. Notably, I think the companies that were weakest during this period are actually the ones that still are the strongest performers on a 3 and 5 year basis. So thinking about that long-term horizon, which is really our focus, I think we're very much still positive on these companies.
So that long-term focus is really important for us, and there is going to be short-term and has been short-term market volatility. And of course, we've just had this report from the IPCC, and I'm just going to quote from the report, the last sentence: any further delay in action and we will miss a brief and rapidly closing window of opportunity to secure a livable and sustainable future for all. So it doesn't get any clearer, does it really? And I think some of these recent trends, in a way, will serve to accelerate this underlying secular shift towards sustainability. So inflationary pressures encouraging businesses to invest more in automation, which have resource and energy efficiency benefits. And then of course around energy, the focus on energy prices and now energy security and the need to move away from Russian fossil fuels, I think will serve to increase people's interest in efficiency technologies and of course the shift to low carbon solutions as well. And then we've also had this correction in stock prices as well, which has meant that stocks that were previously trading on valuations that weren't attractive to us are now perhaps a bit more attractive.
Yeah, and I think when we think about the portfolio, it has always traded at a slight premium to the index because of that higher exposure to quality and to growth. But over the period that we've seen sort of during COVID, the change in valuation has been very much in line with what the index experienced. What we saw during COVID was an expansion in multiples of those higher quality and growthier names. And what we've seen year to date is essentially a reversal of that. So these stocks aren't what you would describe as absolutely cheap when you compare them to value stocks, but they're certainly at levels that we think offer an attractive long-term risk reward for the opportunities that they represent. And I think the key thing is it's enabled us to upgrade the quality and the growth characteristics of the portfolio without really changing the level of valuation relative to the index over that period.
Right. So companies like Spirax-Sarco, which is a business that we have long admired on the investment team, and has recently come back to a valuation which is much more attractive. So I think it's now trading around its 5-year average, and this is a high quality business, very focused on energy efficiency, particularly around the use of steam in industrial applications. So that's the kind of business that we've been able to buy now.
Yeah, I think that's a great example. And I think it's fair to say that despite the environment that we're in and the terrible things that are happening in Ukraine, from the portfolio perspective, we are still positive about the long term. I think when you get these periods of uncertainty, it's important not to let your time horizon narrow down purely just to the here and now. And for us, the long term really is the focus. Our thesis is still intact. These companies play a critical role if the world is going to meet its sustainability challenges. And I think this period has been an opportunity for us to add to quality, increase the impact of the portfolio, and set the portfolio up well for the long term to capture the opportunities that represents.
Great, thanks for that, Vic. And of course, we'll be back in front of the cameras in mid-April for our quarterly update. Thanks.